The chart of accounts is a list of all your accounts and an account description. There's a lot of confusion about setting up the chart of accounts and how to maintain the chart of accounts. So let's talk about that. The first thing you should know is that chart of accounts are typically set up in a certain order. So you have asset, liability, equity accounts, the balance sheet, followed by revenue and expenses afterwards. Normally expenses have the most account categories of any other set of accounts, and those are usually last. So that's important to know. It can also be subdivided into the asset section, current assets, cash, accounts receivable, and inventory, followed by long-term assets like fixed assets. And then in the liability section, current liabilities like accounts payable, long-term liabilities like a bank loan. So those are further separated within the chart of accounts. So very common, cash might be the number 1,000 account, accounts receivable 2,000, inventory 3,000, etc. Maybe you get down all the way to the bottom and revenue is 7,000 numbered accounts and expenses are 8,000 numbered accounts as an example. So if you're using accounting software, which almost everybody does now, there is a standard set of accounts you'll be given. So if you're using QuickBooks, you're setting up a new business, they will give you a standard chart of accounts, but you can change that to fit your industry. And in fact, most accounting software packages have industry-specific software packages, so retailer, manufacturing, etc. Now, if you have a big fixed asset balance, it is very common to have fixed asset accounts in the chart of accounts matched with an accumulated depreciation account. So if 2,100 is a piece of machinery, 2,150 is the accumulated depreciation account. So why is that? Because we want to match the cost of the asset with the accumulated depreciation, because the difference between the cost and the accumulated depreciation is the book value. So if you were buying a pizza parlor, for example, that has ovens and refrigerators and furniture and fixtures, you wanted to know the value of all those assets, you would look at the trial balance, which is created using the chart of accounts, to look at the book value of each of those assets to see what they are worth. So that's why we pair up assets and accumulated fixed asset accounts and accumulated depreciation. Another one is company divisions. So if number 3,000 is your inventory account, and you've got three company divisions, it may be 3,000-10-20-30 to indicate different divisions within the same company for reporting purposes. And finally, remember that all this is used to post transactions to the general ledger, create a trial balance, and create financial statements.